Your money is being repriced quietly. Silver isn't exploding in chaos. It's holding above $51 an ounce. Gold isn't spiking in panic either. It's sitting calmly around 4,162. That's the contradiction. In real crises, prices jump fast and fall hard. This time, they're staying high, steady, controlled, and that should worry you more, not less, because this isn't a retail stampede. This isn't hype. The largest financial institutions in the world are openly adjusting their expectations upward. JP Morgan is talking about gold above 5,000. Bank of America is in the same range. UBS keeps raising its targets step by step, almost reluctantly. That's not excitement. That's acceptance. And here's why this matters to you. When institutions move first, they do it before headlines change, before narratives shift, before the public reacts. By the time most people feel the pressure, the repricing is already done. But here's the part nobody says clearly yet. If these levels aren't the top, then holding cash isn't neutral anymore. It's a position. So what forced this shift now, and why is it accelerating? What's happening now didn't start with a headline. It didn't start with a crisis tweet or an emergency meeting. It started quietly through forecasts, balance sheets, and demand curves that stopped behaving the way they used to. By late November 2025, gold was trading around $4,162 an ounce. Silver was holding above 51. Those numbers matter, but not as isolated prices. They matter because they stayed there. No collapse, no snapback, just acceptance. And that tells you this move isn't emotional. It's structural. This is where the story widens. Multiple major banks are now pointing to even higher levels ahead. Not as a trade, as a base case. At the same time, silver isn't being treated as a side asset anymore. Forecasts are calling for it to outperform gold, not because it's trendy, but because of how the market around it is built. Now notice what's missing from the conversation most people are having. This isn't being framed as a one-off rally. It's being framed as part of a longer cycle tied to currency pressure, industrial demand, and supply that can't respond fast enough. So the real question isn't why are prices high, it's what kind of market keeps prices high without fear. There's a strong claim forming underneath all of this, and it's uncomfortable. Silver isn't rising because investors suddenly love it. It's rising because the market is running out of it in the places that actually matter. This isn't new either. The silver market has now been in structural deficit for 5 consecutive years. That means more silver is being consumed than produced year after year, with the gap filled by above-ground stockpiles. And those stockpiles are shrinking. Industry leaders have been clear about what's driving this. Demand from artificial intelligence infrastructure is growing. Military usage is increasing, but one sector dominates everything else: solar. Current estimates put silver demand for solar panels at roughly 240 million ounces today. Projections push that number toward 450 million ounces by 2030. That's nearly half of all global annual silver production absorbed by a single industry. Not investment, not jewelry, one industrial use. Here's why that detail changes everything. Mining supply can't scale on command. New projects take years, permits take longer, and silver is mostly mined as a byproduct, which means production doesn't respond cleanly to price. Now notice what isn't being promised anywhere. There's no credible plan to flood the market with new supply. So if demand is locked in and supply is structurally constrained, the question isn't whether prices adjust, it's how violently they have to. Now watch how fast this escalates. Because just as supply pressure builds, the institution meant to stabilize everything is starting to freeze. The Federal Reserve is facing a scenario it's never had to publicly manage before. Markets are pricing in rate cuts. Futures data points to an overwhelming expectation that easing is coming. But inside the Fed itself, consensus is breaking down. There's a real possibility of a deadlocked vote, a tie, And here's the detail most people miss. There is no clear mechanism for breaking that tie. No override, no emergency lever. If the votes split evenly, policy doesn't move, rates stay where they are, even if conditions demand action. This is where the story flips. The Fed's power has always rested on its ability to act decisively. Once that decisiveness disappears, confidence erodes fast, not because of what the Fed does, but because of what it can't do. And notice what's being normalized here. A global financial system where the central bank can see the problem, acknowledge the pressure, and still remain frozen by internal division. Markets don't wait for clarity. Capital doesn't sit still during paralysis. When policy stalls, money looks for certainty elsewhere. And that's when assets that don't require permission start to matter a lot more. The pressure doesn't stay abstract for long. It shows up where pricing is supposed to be simplest, the spot price. What's happening now is a quiet breakdown in how silver is priced in the real world. Dealers and wholesalers are no longer relying on the same reference charts the public sees. Some have stopped using traditional pricing feeds entirely and shifted to direct exchange data instead. And when that happened, a gap opened. At one point, the difference between two widely followed silver prices stretched to nearly $2 an ounce. It later narrowed, but it never fully disappeared. That shouldn't happen in a healthy market. Spot price is supposed to be a single number, a shared reality. Here's why this matters. When refiners and wholesalers stop honoring one price and start using another, retail pricing has to follow physical reality, not online charts. That's when investors get confused. They see one number on a screen, then a very different number at the counter. Notice what they didn't deny. They didn't say silver was overpriced. They said the old pricing reference no longer worked. This is what stress looks like before it becomes obvious. Paper markets and physical markets drifting out of sync. A system still functioning, but no longer unified. And once pricing fragments, the next thing to break is trust. And this is where the situation gets materially worse. Because while prices fragment on screens, the physical system underneath is choking. As silver pushed toward the mid-50s, something unexpected happened. The public started selling, not bars, not coins, scrap, old jewelry, sterling, mixed alloys. Everything came in at once. Refineries were hit with a surge they couldn't absorb. Major facilities shifted to 7-day operations and still fell behind. Processing times stretched from days to weeks, then months. That backlog matters more than it sounds like. Dealers rely on refiners to turn inventory back into cash. When that loop breaks, liquidity freezes. Here's the contradiction. Demand to buy investment silver stayed strong, but dealers couldn't recycle what they already had. Capital got stuck, storage filled up, cash stopped flowing back upstream. So some dealers made a move that shocked customers. They stopped buying certain types of silver altogether. Not because silver wasn't valuable, because the system couldn't process it fast enough. This is the line that changes how you see the market. A shortage isn't always empty shelves. Sometimes it's a jam so severe that money can't move. And when liquidity breaks, price behavior becomes unpredictable. The bottleneck triggered something even more destabilizing. A liquidity split inside the silver market itself. Not all silver became equal. High purity, standardized products kept moving. Government minted coins, clean bars, easily verifiable metal. Everything else started to stall. Sterling silver, 90% coins, older circulating silver. Dealers couldn't move it upstream, so they stopped taking it in. Imagine holding silver at record prices and being told there's no bid. Not because demand vanished, but because the exit door is blocked. That's what many sellers ran into. Assets didn't lose value. They lost immediacy. This is where people learn the difference between owning something and being able to sell it. In stressed markets, liquidity concentrates. It doesn't spread evenly. The system narrows its tolerance to what can be processed fastest. And here's the uncomfortable implication. In theory, certain forms of silver are ideal for crisis scenarios. Small units, recognizable, divisible. In practice, under operational strain, they became dead weight for the very institutions meant to provide liquidity. What happens next is always the same. Discounts widen, premiums collapse, strong hands accumulate quietly while weak hands sell simply to regain flexibility. So the question shifts again. What happens if this strain doesn't ease and the system stays selective? That's when behavior starts to change. Retail demand hasn't just increased. It's surpassed the levels seen during the pandemic. Dealers describe lines at the counter, phones ringing nonstop, transactions stacking back to back, and the motivation sounds different this time. This isn't speculation, it's fear. People aren't asking how high silver can go, they're asking whether cash will still work the way it's supposed to. That's a subtle but critical shift. When trust erodes, buying becomes defensive, but fear cuts both ways. Experienced buyers wait for pullbacks. They buy quietly, newcomers chase momentum, they buy peaks. And on the other side of the trade, something just as telling is happening. People are selling irreplaceable pieces just to raise cash. Collections built over decades, liquidated fast, often below their real worth. Here's why that matters. Panic selling at high prices isn't rational behavior. It's liquidity stress. It's people choosing certainty now over potential value later. If this feels familiar, say so in the comments. This kind of market doesn't move smoothly. It lurches. Emotion amplifies every move. And once fear becomes the dominant driver, reversals get sharper, not calmer. The system doesn't slow down from here, it destabilizes. At this point, outrage doesn't explain anything anymore. Mechanics do. This isn't about greed or panic in isolation. It's about incentives lining up in a way that quietly drains flexibility from the system. When trust in currency weakens, people don't need to agree on why. They just need to act in the same direction. Institutions protect balance sheets. Households protect purchasing power. Refineries protect throughput. Dealers protect liquidity. Each move makes sense on its own. Together they create pressure. Here's the unsettling insight. The system isn't failing because of a single shock. It's tightening because too many participants are optimizing for safety at the same time. That's how optionality disappears. Leverage magnifies it. Paper markets promise instant liquidity. Physical markets can't deliver it on demand. When that gap widens, price becomes less about discovery and more about access. Who can get metal? Who can move it? Who can wait? Notice what mainstream coverage avoids. This isn't a collapse story, it's a control story, a slow shift where flexibility migrates away from individuals and toward bottlenecks. And once a system rewards those who already hold real assets, entry doesn't get cheaper. It gets more conditional. That's the mechanism most people don't see until it's too late. From here, the path splits, and neither option is comfortable. In one scenario, pressure eases just enough to buy time. Prices pull back, volatility cools, refining backlogs slowly clear, confidence stabilizes on the surface, but even in that version, nothing resets. Demand stays elevated, supply stays tight, the floor moves higher, quietly locking in a new range that would have seemed impossible a few years ago. In the other scenario, momentum feeds on itself. Industrial demand keeps absorbing supply. Retail fear doesn't fade. Policy paralysis drags on. Any dip gets bought faster than the last one. Not because people are bullish, but because they're running out of alternatives. In that world, prices don't rise smoothly, they gap. Liquidity thins. Access matters more than timing. Here's the key detail. Both paths point in the same direction long term. The difference is speed, not outcome. And speed is what breaks systems, not trends. Watch what happens next. Pay attention not to price targets, but to behavior. Who's buying quietly? Who's selling under pressure? Who's being forced to wait? Because the next move isn't theoretical anymore. It's already forming. Here's the insight that ties everything together. This story was never just about silver or gold. It's about what happens when trust shifts before headlines do. Prices didn't move first. Behavior did. Institutions adjusted quietly. Systems strained silently. And by the time it became visible, the repricing was already underway. When money works, nobody thinks about it. When it doesn't, people rush to things that don't need permission, votes, or explanations. That's the common thread running through everything you've just seen. Not panic, positioning. And that's why this moment matters. Not because of where prices are today, but because of what they reveal about the system underneath. Once confidence fractures, it doesn't snap back cleanly. It reroutes. If you want to understand where this leads next, you can't watch prices alone. You have to watch incentives, bottlenecks, and behavior under stress. That's what we'll keep breaking down here. If you want to stay ahead of the next shift, follow the channel. The surface story always comes last.